Suppose there's one thing Warren Buffett is known for. In that case, it has to be that he is a special type of man and investor with a strong capacity to know the best companies to invest in, even when the business world has entirely written off the companies. But Warren always finds a way to bring it back to life and rejuvenate it in a way that supersedes the glory days of such a company before his involvement. Berkshire Hathaway is one company that benefited from the investor prowess and leadership direction of Warren Buffett. In this episode, we'll be doing a glance at the Berkshire Hathaway Company. The starting days and the glory days. In 1839, Oliver Chase established the Valley Falls Company, a textiles manufacturer, in Valley Falls, Rhode Island. The origins of Berkshire Hathaway can be found here. Chase was formerly employed by Samuel Slater, who founded the first successful textile mill in America. Chase founded his first textile company in 1806. In 1929, the Adams, Massachusetts-based Berkshire Cotton Manufacturing Company and the Valley Falls Company merged. The latter was established in 1889. The combined company was given the name Berkshire Fine Spinning Associates. Horatio Hathaway founded the Hathaway Manufacturing Company in 1888 in New Bedford, Massachusetts, with profits from whaling and the China trade. In 1955, the company amalgamated with Berkshire Fine Spinning Associates. Hathaway enjoyed success in its early years but struggled after World War I as the textile industry experienced a general slump. Seabury Stanton, who oversaw Hathaway at the time, was a successful investor whose efforts led to the company's return to profitability during the Great Depression. Following the merger, Berkshire Hathaway, which had its headquarters in New Bedford, operated 15 plants, employed more than 12,000 people, and generated over $120 million in revenue. By the end of the decade, 7 of those locations had been closed, along with significant layoffs. This is where Warren Buffett came in. Through its owning subsidiaries, Berkshire Hathaway Incorporated, a holding company, engages in a wide range of distinctly commercial activities. It engages in both primary insurance business and secondary insurance business. The management of Berkshire's operating companies is unusually decentralized. Berkshire's corporate headquarters do not significantly impact the day-to-day operations of the operational businesses since it handles business functions like sales, marketing, buying, legal, or human resources. But as you must have guessed and deduced from the earlier part of this video, this sudden change into bliss did not come from the merger of both distinct companies of Berkshire and Hathaway. Neither did this change happen overnight. Interestingly, Warren Buffett's purchase of Berkshire Hathaway did not come from the standpoint of business. It came from a place of vexation to fire the then owner of Berkshire Hathaway for playing him a dirty hand in the business deal. Warren Buffett started investing in Berkshire Hathaway stock in 1962 after seeing a trend in the price movement of the company's stock whenever it shuttered a mill. At this point, he had just enough shares in the business, but it got to a time he admitted that the company's financial situation was not going to get better and that the textile industry was in an increasing decline. In order to get the business to buy back Buffett's shares, Stanton issued an oral tender offer in 1964 for $11.50 per share. A few weeks later, Warren Buffett received the written tender offer, but it was for just $11.38. Ordinarily, the next line of action would have been to sell the shares at a slightly lower price to get the used capital back since he'd bought the shares at a little above $7 and had almost $14 million in stocks. But Buffett is no random investor and the undercutting upset him so badly till he purchased more stocks, gained more control of the business, then fired Stanton when he had the controlling power. While it must have been a sweet payback to fire Stanton, the repercussion of that was that Buffett now owned control with the highest shares in a company that its business was failing. At that point, the company was a complete shell of its former self. There were only 2 manufacturing plants, and just over 2,000 employees remained from its peak employment days of over 12,000 employees. It was evident, for Buffett at least, that Berkshire Hathaway had had its share of the misfortune of the textile industry and it was time to move forward. To what? Buffett knew the movement was to the investment and insurance sector of business, and he wasted no time in steering the wheel in that direction. But the Buffett investment way was different. Buffett stayed away from what the majority of investors on Wall Street were doing, which was to invest in equities based on assets and cash flow and in relatively speculative industries. and instead continued to concentrate on businesses with steady, nearly predictable long-term growth. With this motive, he made the first investment into what would turn Berkshire Hathaway from a failing textile company to a conglomerate with one of the most coveted company stocks in the world. Buffett became the chairman of Berkshire Hathaway in 1969 and, seeing the civilizing effect of the other businesses that the company had purchased, continued to diversify and expand. The start of this purchase was buying National Indemnity Company and National Fire and Marine Insurance Company for a total of $8.5 million. Shortly after that, in 1968, the company made another significant acquisition of Sun Newspapers, a group of Omaha area weeklies. And by 1969, it bought Illinois National Bank and Trust Company of Rockford. In 1978, Continental Divide Insurance Company was established by Berkshire, and in that same year, Berkshire purchased two more insurance companies, Columbia Insurance Company and Southern Casualty Insurance Company, in a merger with Diversified Retailing Company. Southern Casualty was ultimately merged into National Indemnity. In 2000, Berkshire Hathaway purchased Mid-American Energy, a distributor of power, as well as Court Business Services, a seller of rent-to-rent furniture. Additionally, Berkshire increased the size of its industrial base by acquiring U.S. liability insurance group, jewelry retailers Ben Bridge Jewelers, and boot and brick manufacturer Justin Industries. Prior to the year's conclusion, Berkshire purchased Benjamin Moore Paint for $1 billion in cash and Johns Manville Corporation for about $1.8 billion, though neither deal was consummated until early 2001. Where did the power to make such bold moves come from? Over the years, it has been quite a reach to explain how Berkshire Hathaway has been able to amass this number of companies and remain afloat all the same. The company says that it owes this growth and tenacity to a concept they've termed float. Float is any premium payment made to Berkshire Hathaway's insurance affiliates that hasn't yet been applied to a claim. This money, often known as the available reserve, is not actually owned by the insurance company. However, it is still available for investment in whichever manner its managers deem appropriate. The corporation's market value rose to $147 billion in 2021, a rise of $9 billion. Float enables Berkshire Hathaway to quickly acquire and revitalize short-term damaged enterprises. That is exactly what Fruit of the Loom did with their products. The failing apparel company was acquired by Berkshire for $835 million in 2002 after its shares had lost 97% of their value. And aside from this, we can say that Warren Buffett's no dividends paying rule is a good business concept that helped keep the company on the right track. One mistake you could make after listening to all of this is to think that Berkshire Hathaway has had a totally free path since Warren Buffett took control of its leadership. That wouldn't be farther from the truth. Over the years, the controversies that have rocked Berkshire Hathaway came from an attack on Warren Buffett himself. During the financial crisis of 2008 and the accompanying recession, critics of Buffett had greater cause for complaint. During that recession and time of the economic crisis, Berkshire Hathaway made a number of investments that were quite profitable for Berkshire. While opponents have charged that these arrangements were exploitative, they did reflect the costs of doing business at the time. But even before 2008, there had been several scandals. In 1974, Warren and his pattern Charlie Munger were investigated by the Securities and Exchange Commission, SEC, for their investment practices in the Wesco deal and had to forfeit $115,000 for Wesco shareholders. 3 years after this was the Buffalo Evening News scandal. And in 2006 was the $92 million settlement and promised changes to corporate governance practices Berkshire Hathaway had to cough out as a result of General Re, a subsidiary of Berkshire Hathaway, involvement with AIG to engage in finite reinsurance. However, through the diverse scandals and setbacks, Berkshire Hathaway has remained a top choice for investment. When Warren Buffett was 11 years old, he bought City Service Preferred for $38 a share. By the time he was 16 years old, Buffett had collected roughly $53,000 in portfolio assets. He took to stock selection like a master and transmitted that same mastery to Berkshire Hathaway. Currently, the price per share to purchase a stake in Berkshire Hathaway is $340,000 for Class A stock. As of March 1, 2020, its Class B shares are traded for a price of $205. In 2018, the company's total yearly revenues were $247 billion, and its market cap was above $500 billion. In terms of revenues, it's ranked as the 12th largest firm in the world.